You're listening to Market Champions, a podcast on navigating the financial markets. Here's your host, Srivatsan Prakash.
Hey guys, I wanted to take this opportunity to remind you all to like and subscribe. It really helps me to keep getting the best guests onto the podcast. So I really appreciate it if you did. And now onto the video. Hey guys, welcome back to another episode of Market Champions. Today we've got Michael Green from Logica Funds. Thank you so much for being on the podcast, Michael. It's awesome to have you.
Thank you. I appreciate it.
Michael, could we start by telling the audience a little bit about your background, what you do, and your journey to how you got to where you are right now?
Sure. So I've been in markets in one form or another for about 30 years. And like many people in markets, I went to school, studied finance in university at the Wharton School of Business as an undergrad, transitioned into management consulting, and then had the opportunity to start a software company in the mid-1990s focused around the business on valuations for corporations, particularly focused on corporate strategic planning departments and helping them to understand how to value their business units. Was lucky enough to run into a gentleman by the name of Mitch Julis, who was one of the founders of a firm called Canyon Partners. He suggested that I link my valuation engines to the public equity databases, which gave us the opportunity to create a tool that could be used for valuing public companies. That led to the sale of that business in 1999 to a firm that was ultimately acquired by Credit Suisse. And it was at that point that I transitioned to what's referred to as the buy side in the market and began an investment career that has lasted for going on 21 years now, managing assets everywhere from small cap equities to today I run a style that's called discretionary global macro with a particular focus on long volatility, which involves owning options on equity indices and other products with the objective of offering an uncorrelated return to the underlying market direction.
Got it. So when did you make that shift from sort of being a value guy to being more focused on stuff like global macro and the quantitative analysis?
So I don't really think of it as a shift as much as I think of it as a continuum. Anytime you start a software company, you're focused on using quantitative inputs to determine a somewhat qualitative output, right? Is a company overvalued or undervalued? And so growing from that base, I always looked at the world from a very quantitative framework, trying to understand not just an individual company, but also an industry or a sector or a market in total. And the formal transition away from single security analysis towards what's referred to as global macro began in kind of the 2006 time period, as what as colloquially as the Big Short began to develop. Became very clear to me that there was something wrong with the housing finance market and that there was behavior that created opportunity. And so I was fortunate to begin the process of participating in that. As we came out of 2008, it was very clear that the structural changes that had occurred in the market with the introduction of the Dodd-Frank rule and the Volcker rule changed the underlying conditions under which derivative contracts could be written or purchased or sold. And for me as a value investor, I actually began to spend my time disaggregating the derivative contracts, trying to understand exactly what claims I was receiving, exactly why somebody would be selling it or why they would be pricing it at the level that they were pricing it. And that really is what kind of cemented the transition away from single security analysis into more of what I would refer to as a product analysis.
Got it. So I wanted to start off with, some of your views on passive ETF flows, which is what you're best known for, and talking about sort of tail risk hedging as well. So I wanted to start off by asking, if someone wanted to have a permanent tail risk hedge, what are the best strategies to implement in that kind of situation? Because usually WIX calls tend to usually be expensive, especially from a time decay or a rolling perspective. And so unless someone gets the timing spot on and the VIX, explodes, it usually seems impossible to have some sort of an efficient hedge. So, how would someone have a permanent and, specifically permanent hedge against, tail risk?
So I think that's actually part of the problem. Is I think it's impossible to have a permanent tail risk hedge. I don't think that exists in the market. In one form or another, it's existed for the past 30 years, 23 years, in the form of U.S. bonds that have taken on a negative correlation to U.S. risk assets or broadly to risk assets while still offering a positive return. So you've been able to diversify your portfolio and own bonds to provide that type of protection. Boy, it looks like my blue screen is really acting up here. The part of the challenge in markets is that there is no such thing as a permanent portfolio. There is no such thing as a stable allocation. You're constantly being forced to make a conditional evaluation of the market. Is a VIX hedge attractive based on the dynamics of how the VIX is being purchased or bought or sold? What are the products that reference that type of contract, et cetera? And so, I think I'm best known for what I've talked about in terms of the dynamics of passive investing. But kind of the first place that I caught a lot of public attention was with the blow up of XIV, where I had recognized that the growth of the products associated with the VIX ETFs, the inverse VIX ETFs in particular, it actually changed the underlying structure of the demand for VIX futures, UX futures, and the options that were priced on those products were just structurally incorrect, right? And so that would be a perfect example where a product that was harmless at its start grew to a size that there was no capacity for the market to clear. And as a result, what had been a very profitable and attractive product turned into a very dangerous product, right? And so that's what you're always going to be looking for, are the components of the change in market structure that create, Hyman Minsky it's referred to as the Minsky moment, right? Where stability begets instability. That's what you're always going to be looking for in a hedge framework.
Right, got it. So do you have any hints or do you have any tips that you could give our listeners on how they could, sort of quantitatively, identify these Minsky moments? That's sort of the $1 trillion question, but I want to hear your thoughts on it.
Well, wait, are you paying me $1 trillion for the answer? So everyone has different approaches to these things, right? And so the way that I try to approach things is I try to understand what are people going to be forced to do. And so that can take a variety of forms, right? If you encounter somebody who is long and short a particular set of securities, you know that if you press their shorts, not only are their shorts going to move against them, and therefore they will be forced to cover their shorts, but in the process of unwinding that portfolio, they're also going to sell their longs, right? So you can identify those types of relationships. You can identify relationships that exist because a dealer is forced to hedge a position given the underlying parameters around risk control. And so again, coming out of the global financial crisis in 2008, I was fortunate to realize that the Volcker Rule and Dodd-Frank had changed the underlying structure of how insurance products in the form of selling puts or selling variance contracts or selling interest rate contracts, how those had changed in terms of their treatment on the balance sheet of dealers, and that created a very different distribution of the potential outcomes, right? So instead of a significant move being absorbed onto dealer balance sheets, suddenly it was forced into the open market. That changes the way that these things behave.
Right.
And so that's the way I always approach it. Is anytime I'm looking at a new product, I'm trying to figure out who is the buyer, who is the seller, what are the rules that they're operating under, what are they forced to do, what are the conditions that I can create or that could be created that would necessitate a transaction, right? And so that's just the way I happen to approach it. A lot of other people approach it from different standpoints, right? They'll look at a historical relationship and say, I think this is going to continue. That would be somebody who's expecting a mean reversionary type frame, right? My most successful trades in my career have been the environment in which I found something where somebody anticipated mean reversion. And if you anticipate mean reversion, which is effectively what a value investor is supposed to do, you're presuming that the historical distribution is going to be very similar to the forward distribution. And that that creates opportunity for people who are willing to look in the opposite direction.
Got it.
I'm going to turn off my blue screen so that everybody can stop being distracted by the San Francisco Bay appearing and disappearing. Just give me 1 second here.
Sure.
All right, now you get to see my workout equipment.
So, when you try to identify convex trades, and, for someone listening, convex is just broadly the sensitivity of a product to the underlying price. So, what is sort of your framework for identifying these convex trades? And, is it more frequent in one asset class or in one market than the other?
So just to clarify, right? So convexity is the change in price relative to the change in price of the underlying or the direction of the trade, right? And so a convex trade is one that has really an asymmetric payout function where there's much more to make than there is to lose.
Right, yeah.
The opposite of a convex trade, for example, would be long a bond, right? A high quality bond, you are getting a very low interest rate in exchange for the potential catastrophic loss of all principal. Right now, you don't expect that to happen. It's a very low probability event, but because it's a very low probability event, you're receiving almost no compensation for that risk. One of the tricks, again, going back to how do you identify trades, is to understand that occasionally markets will reprice those probabilities. For example, in March 2020, suddenly investment grade bonds began pricing in a significant amount of risk relative to a risk-free bond like the US government. That creates opportunity to trade on the other side. And every other asset in one form or another is going to be priced in a manner that is relative to another asset, right? So when I think about equities, would I rather own equities at a expected forward return of 10%, or would I rather own investment grade bonds at an expected forward return of 10%? Well, the answer there is unquestionably, I'd rather own investment grade bonds.
Yeah.
Right? The certainty of my principal repayment, the certainty of my receiving that 10% is dramatically higher. And so in an environment in which investment grade bonds are offering 10%, equities should offer something more than that, right?
Right.
Now, equities are an interesting vehicle because they have their own unique characteristic. And it's one of the challenges I think that people often run into when they think about things like a dividend discount model, or the idea that you can simply relate interest rates to equity prices and say, hey, low bond yields therefore mean that equities should be priced very richly. Part of the challenge with that is that the two aren't actually comparable assets unless you begin to incorporate elements of optionality. So if you're familiar with the dynamics of put call parity, you recognize that the value of a stock is equal to the value of a call minus the value of the put plus the present value of dividends plus the present value of the strike price at which the options are written, right, or purchased. So in other words, because you're long a call, you get to participate in all the top side. Because you're short a put, you get to participate, you lose as the stock goes down. You have a claim against the dividends, right? And if you're going to synthetically create this, you have to structurally buy effectively your strike price so that you can make sure that you can execute it as you look forward, right? Well, suddenly that becomes a very open-ended product. Right? As it goes down, you lose money all the way to the barrier where effectively all you've received are the dividends, which are uncertain in nature, and potentially you've been completely wiped out, right? On the other end of the spectrum, it could theoretically rise towards something infinite. And so equities price on a dynamic in which the maximum point of uncertainty is in the future.
Right.
A bond does the exact opposite. I don't know what the price, 10-year bond, I don't know what the price of it is going to be in 5 years. If it's a high interest rate environment, its price will be below par. If it's a low interest rate environment, its price will be above par. But if it's a high quality bond, I know exactly what it's going to be worth in 10 years, which is par value. Right? So the point of maximum uncertainty in a bond is the interim period, whereas the point of maximum uncertainty in an equity is the end point. As a result, you can't relate the two unless you include options in your pricing mechanism. You need to understand how options work quite deeply and theoretically in that framework. And so, that's just kind of one of the wrinkles that I would add into this, is that, we tend to be presented with relatively simplistic models of how the world works. In the classic line, it's complicated, right?
Right, got it. So I also wanted to ask you, moving on to talking more about ETFs and flows, what are your thoughts on factor ETFs that, specifically account for one factor, say growth or value, or do you see those factor ETFs as making the market more efficient, or do you think they make the market less efficient?
Well, I think they do something very different than what people think they do, right? So first, I just want to emphasize when we use the phrase ETF and passive, I don't consider things like factor ETFs or sector ETFs to be passive vehicles. They are systematic strategies that have their own unique characteristics to them, and they can reinforce or they can dampen influences of other components in the marketplace. But it has very little to do with ETFs, right? Because a traditional mutual fund that is a value factor mutual fund is going to behave much more like a value ETF than a value ETF and a growth ETF are going to behave like each other, right? So the actual product doesn't matter nearly as much. There are issues associated with ETFs, and that you have the perception of higher liquidity for the overall product than for the underlying instruments. Many critiques have been leveled against credit funds for this reason. We're seeing an element of that in products like, Cathie Wood's ARKK family of ETFs, which are coming under some pressure for holding illiquid assets while offering intraday liquidity. But the ETF is not really the important component there. So I just want to emphasize that. The second component is when you talk about a factor ETF, understand what a factor ETF is really doing. It goes back to that observation I was making before, which is if you're buying a factor ETF that's, let's say, for example, a value ETF, right, or a value mutual fund, what are you actually doing? Well, what you're doing is you're setting in place a series of rules that you've agreed to in advance. And so, for example, the rule for a value ETF is if a stock in my portfolio outperforms the market enough, I will agree that when the rebalancing period comes, I'm going to sell that stock, regardless of whether I happen to like it, or I think it's a wonderful company, or if the fundamentals have improved. Right. If its price is appreciated to the point that it ceases to be value and it becomes core or it becomes growth, I will sell it out of my portfolio, right? So what I've done is I've pre-committed to a short call position, right? Likewise, if a security that's not in my portfolio falls in price enough that it becomes quote unquote a value stock at the next rebalance, I agree in advance that I will buy it, right? Now it seems really easy when you present it in that framework, and I'm happy to share that type of analysis, but I guess it's really hard to figure out that's what's actually happening, right? And a portfolio that is selling calls on securities that I own and selling puts against securities that I don't own, right, is a portfolio that is short optionality, has negative vega exposure, negative volatility exposure, right? And as a result, should offer me a premium return, right? I'm taking on additional risk above and beyond the ownership of the stocks. And so in our analysis, I mean, this is one of the pieces that I wrote about last year in terms of, let's talk about, talking about value factor and what it actually means. That pre-sale of that optionality largely explains the historically observed value factor. And as people crowd into those types of strategies, they depress the price of those options. And that in turn influences the market structure itself and creates opportunities for players like myself that want to buy that optionality.
Right.
So to answer your question about efficiency, I think it has very little to do with efficiency, but broadly speaking, the more systematic strategies grow, the more passive strategies grow, where the rules are agreed to in advance, the less efficient we should expect the market to become.
Right. I agree. And one thing that you mentioned in your previous answer was, the fact that, ARK was, ARK came under some criticism because, they had some bad liquidity management. So I want to ask you, what are your thoughts on the ARKK ETF or, the ARKK ETF family as a whole and, their management of liquidity?
Well, I have no insights in terms of how ARK manages its liquidity or even constructs its portfolios. I have to give hats off to Kathy Wood for having built, an extraordinary organization and environment in which many active managers have struggled significantly. With that said, I would observe that her style of investing, which is basically momentum on steroids, is perfectly suited for an environment in which passive is gaining increased share, right? Because ultimately passive reinforces momentum strategies. It allocates more money on each incremental dollar that comes in. More of that is allocated to stocks that go up and less of it is allocated to stocks that go down, right? That becomes a momentum reinforcement, a value negative reinforcement loop.
Right. I also wanted to ask you, how do you measure, capital flows in real time, and how do you use that as sort of a functional or a practical matter in order to predict price movement? Do you primarily say mine the data from a Bloomberg terminal and then build your own model? How would someone actually go about using capital flows, in practice?
So the quick answer is that I monitor these things more than I try to predict, right? And so there's fairly clear evidence, particularly as you look at sector ETFs or as you look at factor ETFs, that as money crowds into these styles, it becomes positive reinforcement as it occurs, right? So if money flows into the value factor, you're going to see a positive bid to value stocks relative to history. That is reinforced by the growth of passive strategies that don't react to price changes, right? At least not in the traditional sense, right? So if a lot of the market is owned by a Vanguard total market index, for example, and then money flows into value strategies, value stocks can appreciate sharply without generating a tremendous amount of selling from the underlying holders, right? On the other end of the spectrum, when money has been flowing out of a style or out of a particular ETF, that can actually indicate two separate components to it. One is that the quantity of selling that is left to occur is relatively low, right? So if people have abandoned the value style or if people have abandoned small cap, then the opportunity set is probably larger for a reversal of that process.
Right.
So I track both of those, and just very quickly, the nice thing about ETFs is that their shares outstanding and the quantity of securities that they own, and therefore their flows can be measured quite easily on a daily basis. Mutual funds are a little bit difficult. So, their reporting of flows and liquidity ranges from anywhere from a week to a month, but almost none of them have the sort of daily information that is available on ETFs.
Got it. Yeah, I've got two more questions on, passive management and, the passive ETF. So, what catalysts do you see, at least on the horizon right now, that could cause net outflows from passive ETFs? Anything that, you've got on your radar or anything that you're watching right now?
Well, I think that there's a couple of things that are important, but hold on, my dogs are going. Can you hear my dogs in the background? They're going a little crazy. All right, hold on. I'm gonna mute for a second.
All right, sure.
All right, things seem to have settled down in the green household. So when I'm looking at the dynamics for passive investment, this is actually one of the real problems that I have is that in terms of the rotation towards passive, there's very few catalysts that I can point to, right? So your generation, you're actually too young to really even be in this position, but as you begin to get jobs, you will be exposed to the 401k industry. The 401k industry is structurally set up such that money flows into passive strategies, right? And participating in 401ks is one of the best bargains that you as a young person can do. You're typically receiving an employer match, right? So let's say you're withholding 5% of your salary and your employer will match up to 5%, which would be generous, but certainly plausible. Under that sort of condition, that means you double your money the minute you put it into your 401k, right? So like I think the technical term is you're an idiot if you don't do it, right? But the second component is that your employer then has a series of incentives that force them to pursue a passive strategy. And the most important of those is that they expose themselves to liability if the products that they offer in their 401ks are either offer forward inferior performance, right, which is unpredictable. There's no way your employer knows what's going to happen to the market going forward and which style is going to work. And as a result, I mean, if they did, they'd be foolish not to go into my business as compared to doing whatever they're doing. But they're forced to push people into passive vehicles in order to remove some of that liability, right? The extreme example of this is that Fidelity was recently, in September of 2020, was forced to settle on a class action lawsuit brought by their employees because Fidelity was offering Fidelity funds in their 401ks, and those did not have the cheapest management fee costs associated with it. The second, the second component associated with that is because the penetration of passive strategies, in particular things like target date funds, which is the qualified default investment alternative as money begins to flow into those sorts of retirement accounts. Because those are largely passive and because they're so formulaic and because they're so widespread, the younger generation is just going passive, right? Penetration rates for the younger generation is somewhere in the 90 to 95% range. The older generation is much less passive in terms of its allocation schema. And so simple demographics are causing the growth of passive, right? It's being reinforced by the regulatory framework, et cetera. So are there catalysts that could cause an unwind? Sure, right? I mean, one is as older people begin to own more passive and as they begin to actually sell down their exposures to fund their lifestyles, right? To turn their 401k into tuna and cat food that they can live off of. You know, that creates conditions under which we can begin to see selling from these super simple vehicles. And what I emphasize is that I talked earlier about the rules of how a factor portfolio is constructed. The rules to how a passive portfolio is constructed is remarkably simple, right? It really boils down to, did you give me cash? If so, then buy. Right. Did you ask for cash? If so, then sell. Right. And then as we look at things like target date funds, they also have an interesting wrinkle to them, which is based on how old you are, we are going to change your forward allocations. And so the only real catalyst that I can point to over the short term would be either a horrific recession that resulted in significant job losses amongst the younger generation that is contributing to 401ks, or simply the passage of time that leads ultimately to enough older generation liquidating their passive exposures such that it offsets the contribution from the younger generation. And that's just not immediately on the time horizon.
Right. Got it. And, you talk about, the younger generation as a whole sort of shifting more towards passive, especially through 401ks. So, where do you see passive management as a percent of assets in the next 10 years? So say by 2030, where do you see, passive management?
So that's a somewhat open-ended question because a lot can change over a decade, right? And if I'm hopeful that many things will change. To answer the question directly, right now, I think that passive, inclusive of the institutional space, where there's lots of products that are not passive mutual funds or passive ETFs, things like total return swaps, CITs, which are unregistered or it's not the right phrase, but they're effectively white label mutual funds that don't have to go through the 40 Act regulation dynamics offered by corporate plans. They are lower cost. Total return swaps, I believe I mentioned, futures, various other products, including things like ETFs, et cetera. Right. When I add all of those things up, I get to about 43% of the market cap is now structurally tied into passive strategies in one form or another.
Right.
That is gaining at about 3% a year. And that 3% a year itself is accelerating.
Got it.
Right.
Yeah.
So part of what's ultimately happening is that we're moving more rapidly towards a very high share of passive. And that creates its own challenges because on my math, once you begin to pass about 50% passive, then the market begins to behave in a very distinctly different fashion, right?
Yeah.
I went through this in some detail with Carson Block, but just the simplest way to think about it is that market participants are both providers and demanders of liquidity. And once you pass about half of the market participants who are unwilling to transact with you for any reason whatsoever, other than their end investor said, hey, here's more money, or hey, I need money, right? The market liquidity begins to break down, and the ability to have a continuous market, in other words, one that trades, $1, 101, 102, 103, begins to break down, and you begin to see a lot of gaps. And I would suggest we saw stuff like that in stocks like GameStop or AMC movie theaters or Hertz earlier in 2020, right? The warning signs of all this sort of behavior are already there.
Got it. So sort of passive is going to lead to its own end because eventually we're going to have.
That's my fear, is that we're gonna we're starting to see this, right? I mean, we all kind of feel it. Anyone who has studied historical price behavior in markets now kind of looks at it as like, wow, this doesn't really make any sense.
Yeah.
You either have to accept that Robinhood traders have so totally fundamentally changed the market, and that my biggest pushback is against the Fed printer goes bird type dynamic driving everything. There's truth to all of these stories. They each carry a kernel of truth to them. But for me, the single most important component is the changing structure associated with the growth of passive.
Got it. So I wanted to move on to something that you're well known for, and that's your opinion on Bitcoin. So I wanted to start off by asking you: do you sort of see the distribution, especially the fact that Bitcoin has a lot of whales or big owners, so people who own a lot of Bitcoin? Do you see that as a major problem for Bitcoin?
I don't want to get too deeply into Bitcoin or for a variety. Oops. Can you still see me, or am I frozen?
Yeah. Okay. Yeah.
So the minute I start talking about Bitcoin, there, my internet starts to go a little bananas. I just want to be cautious in terms of conveying, any form of certainty on Bitcoin, right? What I'm trying to explain to people with Bitcoin is that many of the narratives that have been shared, ranging from what is the definition of money, or how does money work, or what should you be looking for in money, Bitcoin is fundamentally founded on a false premise that the way to add value to money is to make it quote unquote harder, right? In other words, harder to obtain, harder to replicate, and that you should be taking control of this away from the government. There's just no evidence that that's true, right? And the reason that we have money is it is a social good. That social good ultimately involves human beings, and those human beings are going to make choices, whether it is along the lines of moving harder, or whether it's along the lines of choosing to support a more flexible monetary system. There's just a lot of misunderstanding in the Bitcoin community, because it is fundamentally built out of this Austrian framework that says, the real problem is that we left the gold standard, right? And gold itself is inferior because we could have found it in an asteroid, right? Those are just silly arguments. They're not actually serious arguments. And I understand that the narrative around Bitcoin in terms of the excitement is very clear, right? Number goes up sort of framework, of course, makes people think that things are working properly. Again, I'm very comfortable in saying, holding simultaneously the idea that the price is going to go up as long as demand continues to rise for a product that is in quote unquote fixed supply. And I would suggest that it can be broadly manipulated upwards in an extraordinary number of ways. But that does not ultimately set up the conditions under which Bitcoin can succeed in the framework that is being presented to individuals.
Right.
And the most frustrating part for me is that younger people who gravitate to Bitcoin in the same way that younger people in my generation would have gravitated to the .com story, right, are going to end up being the individuals that are most at risk, right? If Bitcoin succeeds, those who are trading human labor for Bitcoin are going to find themselves far behind those who have accumulated wealth and continue to hold it.
Got it. Yeah.
right? And it's, it makes me sad. I think it's unfortunate.
It's true. I mean, yeah, I mean, if you think about it, a lot of people are just sort of lured to Bitcoin because it sort of offers this get rich quick kind of scheme because it sort of just keeps going up in a sense. So yeah. So anyway, I wanted to ask you, what must happen to Bitcoin for you to admit that your original thesis as a whole, was wrong? Like what's sort of like the case against the Mike Green case?
Well, the case against the Mike Green case is that Bitcoin succeeds, right? That it is adopted
Right.
by the governments of the world, it is chosen as a world reserve currency, that governments that have, particularly the United States and several other governments that have carefully husbanded their resources to be able to accumulate the ability to project power on a global basis and over their citizens, concede that power, right? And say, hey, you know what? There's nothing we can do to stop this. And therefore, we're going to give up the power of seniorage, right?
Got it. Yeah.
I mean, look, it's possible. There are own goals that are done all the time in games like soccer, right? And there are own goals that occur in politics, certainly in history. An own goal could occur. I think it would be a terrible outcome. I don't want to be in that world, but I understand why people think that that might happen. Again, I think that their fundamental premise is wrong. Right? That the idea that the harder the money is, the better everything is going to be. But, ultimately I'm one voice amongst many, and others can choose to make those mistakes.
It's true. So, I bet you've never ever, bought a book by say Mises or Rothbard or any one of those people.
Sorry, say that again?
So I bet I could guess that you've never bought a book or read a book by, Mises or Rothbard or, one of those Austrian economists, because they sort of fundamentally disagree with that view.
Well, the fact that I fundamentally disagree with it doesn't mean I wouldn't buy the book. I own my book. I owned, tons of stuff by Hayek and Mises, et cetera, right? I've read the materials. That doesn't mean I have to agree with them.
Right, that's true, yeah.
And I find them interesting intellectuals, but I would also just suggest that much of their insights, right? If I go back and I look at Menger, or if I go back and I look at Hayek and Mises, et cetera, right? They in turn were reacting to a world that they had participated in.
That's true.
Right?
Yeah.
So the dynamics of the German hyperinflation would permanently affect the outlook for a subset of the population, and certainly in the form of economists, right? Understanding that, diagnosing it properly, that's a totally different dynamic, right? And my interpretation will be different than others. It doesn't, there's no way for me to say that I am right, because I can't tell the future. I can look at the underlying facts, and I can come to a conclusion that makes me comfortable with my analysis. But, to your point, like, what would lead me to say that I'm wrong? Well, clearly, if I think that ultimately Bitcoin will be banned by governments because they will be unwilling to accede to the dynamics, if governments chose to accede to those dynamics, then I would be wrong.
Yeah, I agree. Do you have any opinions on, say, Ethereum or any other DeFi cryptos?
So I think this is actually one of the really important components, is that I ultimately think that we are heading towards a world of tokenization. I think that we are heading towards a world with a variety of DeFi-like characteristics, right? With DeFi broadly meaning decentralized finance, there is no question that the shadow banking or the distributed banking system and the ability to provide banking services more broadly to an audience without the intervention of government agents, I do think that's actually going to grow. And I think, many people have seen stuff that I've done with Rohan Gray, or have listened to Rohan Gray speak. And I would encourage people to do that, because both Rohan and I would very much be in favor of the innovations that are occurring along those lines. But I think that we both would suggest that the idea that the government shouldn't play a role, particularly a democratically elected government that represents on a truly representative basis the will of the people, right? You need to actually have that offsetting influence. It can't just rely on those who have money or access to the systems of control of money to determine that, right?
I agree.
And I just broadly think that people, lock themselves into a mode and are unwilling to explore, many of the other reasons behind it. The structural features of Bitcoin in particular, where it effectively was created in the aftermath of the global financial crisis as a reactionary component from individuals who are at their core deeply libertarian. It's somewhat self-explanatory that it's behaving the way it is.
Yeah. Now, out of curiosity, could I ask you, without any like debating or anything, but where do you stand on the political spectrum as a whole? I'm just curious.
Wait, I'm sorry, could you repeat that?
Yeah. So where do you stand on the political spectrum as a whole, if you wouldn't mind sharing?
So the quick answer is that, like everything else, it evolves, right? Given a preference, I would choose to have the private sector play a larger role than the public sector. I tend to think that innovation occurs out of the private sector, and that we are generally better off if there are goods and services that can be provided by the private sector to allow those goods and services to be provided by the private sector, for the simple reason that a clear profit feedback mechanism exists.
Right.
But the environment that we have today is not one where that's actually true. And this is, where the perverse characteristics begin to play through, right? We saw this with the coronavirus response, where a crisis in the public markets leads to a reaction from officials that is not necessarily available to the private sector. So we've seen thousands and thousands of small businesses close down, and sole proprietors lose their livelihoods, while the corporate sector was broadly protected.
Right. That's true.
That inequity is not a public versus private discussion. It is a regulatory capture discussion.
Right.
And my broad sense is that the regulators have been captured at this stage by a private sector of large corporate entities that have been granted vehicles like personhood that allow them to influence the regulatory process to the extent that it is now beginning to harm us.
Right.
And we've been through periods like this before. I mean, people who have listened to other podcasts know that I encourage people to read side by side Amity Schlei's The Forgotten Man, which is the story of how unintended influence or unintended impacts of government action can harm the economy. And read that next to Matt Stoller's Goliath, which is the opposite, right? The battle against monopoly. And so people tend to forget that in the 1930s, Alcoa, for example, refused to build additional aluminum plants and aluminum capacity so that the US government could begin growing its military and adding planes, because they perceived that would be harmful to their global monopoly in the aluminum trade. And they felt that the aluminum needs could be served from their factories in Germany.
Right. Yeah.
Right. Now that's, that creates the conditions under which the US government has to respond by saying, okay, we're going to create competitors in Reynolds, and I'm blaming on the other one, Kaiser. But they have to do that because ultimately you can't rely on the corporate sector to make a decision around national security. And I'd point to the examples of Apple today, where they are making agreements to provide access to the Chinese government and the Russian governments that they will not accommodate for the US government.
Right. Yeah.
Now, I'm not suggesting the answer is for the US government to have the same access that the Chinese or the Russians have, but that's telling in terms of the underlying dynamic, right? Again, we have a corporate sector that tends to think of itself as supranational at this stage.
Yeah.
And I just disagree with that.
Got it. And, with that, with what you just said, I wanted to sort of go into and talk more about the macro and the geopolitical environment as a whole. So I wanted to start off by talking about, from your experience, what is the information content of the yield curve, specifically the U.S. Treasury yield curve, especially towards the long end? And do you think that 10 to 30-year rates actually convey good signals about economic conditions, reflecting transactions based on pure supply or demand, or do you think they convey something else?
Well, again, I think you end up in an interesting situation where the historical relevance has been diminished, right? The growth of passive strategies in bond funds has been significant. They're now about 25% of the bond market. And just like in the equity markets where they reinforce momentum, in the bond markets, they reinforce momentum. So the incremental dollar that comes into a bond fund buys things in proportion, buys bonds in proportion to their market value, right? The market value is affected by what happened to the price. So if the price of the bond goes down, reflecting particularly, let's think about long duration bonds, for example, right? So if the yield curve is steepening and the long duration bond falls in price, that next dollar that comes into the bond fund buys less of the long duration bond than it does of the shorter dated bonds in proportion to what it would have done the day before. That creates momentum in bond indices that historically has not existed. And I'd say that's exactly what we're seeing, right? So just like the equity markets, I think unfortunately we're beginning to lose the information content in the bond markets, and that influences policy. That's part of, I wrote a paper last March called Policy in a World of Pandemics, and highlighted for people that the information content that they were receiving from markets that's leading to policymakers making decisions is increasingly short-circuited as passive strategies become larger and larger in markets.
Got it. And recently on the I believe it's called the Hedging Investment Summit or Hedging Investing Summit that's hosted by Keith McCullough, you said that the reflation narrative was overdone. So could you sort of give your thinking behind why you said that, and do you have sort of any thoughts on timing the move or the trade of going against the narrative?
Were oil prices up or down today?
I don't remember.
They were down, so it clearly started yesterday. Now, what I was highlighting for people is that the structure of the forward curve in commodity markets contains information. And again, this is one of these situations where it becomes a question of how is it influenced by systematic allocation? So money, for example, flowing into commodity funds, DBA, for example, in the agricultural space, or USO in the oil space, or any variety of natural gas funds, et cetera. The structure of those vehicles influences market behavior, right? But there's also some information content there, right? So if people decide that they want to buy oil funds or they want to buy a natural gas fund, the actual structure of that vehicle that they end up buying is going to influence it. So if they're buying a natural gas vehicle that buys the second month future or the second future, right, that's going to experience buying pressure relative to the rest of the curve. Historically, the way to think about commodity markets is that they range between what's called contango, where the back end, right, so forward months are more richly priced or higher priced than the front months, or backwardation, which is the opposite condition. The normal condition in general for a commodity market is backwardation, where you are paid for storing something, right, so that you're basically rewarded for the price rolling up over time, right?
That's true, yeah.
When a market moves into contango, what it's saying is there's a surplus today, right? And you are going to be compensated. If you put it into storage and keep it for us later, you'll be compensated for that. The extreme variant of that was last May, where oil prices on a short-term basis went negative because oil is a toxic substance, right? You can't just take it and store it in your house, right? It'll literally kill you if you decide to fill your house with it, right? So the actual storage of that required the prices to go negative to incentivize people to take the risk of taking delivery of that product and being uncertain if they could actually find storage for it, right? They were very well rewarded for taking that risk, because if I looked out a year, the price of oil was somewhere in the neighborhood of $40, right? So from negative $37 to $40, that's a hell of a move in terms of the reward for storing that oil. Today, we're seeing the opposite condition, where the price is higher today than it is in the future, indicating that we're actually trying to obtain sourcing in the current market, and we're less worried about shortages in the future. And what I was highlighting on the Keith McCullough piece is when that condition broadly exists across commodity markets, it's usually because so much money has flowed into commodities or the commodity space that has created the perception of shortage. But what's really happening is that it's a financial shortage, right? The product has been purchased and people are owning it for financial purposes over and above the actual fundamental needs for it. Historically, that's led to roughly a 6 to 12 month lead in terms of commodity prices declining. and that would broadly be my forecast. If I look forward 12 months, I think there's a very reasonable chance that the price of most commodities are lower than they are today.
Got it. Do you have any thoughts on, the overall currency or the FX markets? So, I don't think many people have actually probed you on, Forex recently. So I just wanted to ask you, do you have any thoughts, any currencies that you're watching overall?
Well, I mean, I have a lot of thoughts on currencies. I guess I'm looking for what you're asking for. Am I worried about the U.S. dollar collapsing? No, I'm not. Right.
Yeah.
And broadly, I would point people to the fact that if you look at currencies, they are kind of the ultimate relative game, right? And the core question is the U.S. that much worse off than everybody else, right? Would you rather own U.S. dollars or would you rather own Turkish lira?
Mm-hmm.
Right. What the behavior in the market is certainly telling people that they would rather own U.S. dollars. Would you rather own U.S. dollars or would you rather own the Brazilian real? Well, most people would
USD.
rather own U.S. dollars, right?
Mm-hmm.
Would you rather own U.S. dollars or would you rather own Japanese yen? Right. That starts to get a little bit trickier, but I would point out to people that the Japanese yen broadly is weakening and Japan is facing a potentially catastrophic situation. If China were to successfully invade Taiwan, that would suddenly reveal that the U.S. sphere of influence, its ability to protect Japan, is suddenly deeply in question, and Japan would have to radically increase its government spending on items like defense, which would lower Japan's productive capacity in terms of its ability to export and run a current account surplus. Right? It would suddenly need to import a whole bunch of stuff and reallocate a significant fraction of its resources. So it's not at all clear that the right answer is that the Japanese yen is a better play than the US dollar under those types of conditions.
Mm-hmm.
Right? Is the Chinese yuan a better investment than the US dollar? Well, I mean, China has some extraordinary problems that the US doesn't have yet, right? Including actually being more levered, having a more aggressive monetary policy in terms of the provision of liquidity under most situations, having a phenomenally state sector that is increasing in terms of its allocation, and most importantly, has a demographic problem that is almost unfathomable. Right? I mean, graduating high school classes today in China are 45% smaller than they were 30 years ago. A world in which there's 45% fewer 18-year-olds in your population is not a world where your economy is going to grow like mad.
Right.
Right.
Yeah.
And it creates surplus in many areas that you don't want to have surplus, that have historically been a significant driver of the Chinese economy. For example, the housing component. When you go from 8, 4, 2, 1, right? That's 8 houses to 4 houses to 2 houses to 1 house, right? It's actually 4 to 2 to 1, right? But you create conditions under which there's extraordinary surplus. And to offset that through shoddy workmanship, that means that the house that you've built or the apartment complex that you've built is highly likely to fall over, right? In a Potemkin village sort of framework, that's not exactly, a sterling advertisement for the value of your currency. So I think FX is one of these important areas that people tend to treat very simplistically. Again, it goes back to the Bitcoin narratives of the US dollar is collapsing. It's not. That's just an untrue statement. And if you believe that it is a true statement, then you need to actually re-examine the fact pattern on which you're making your analysis.
Yeah, but usually people just point to the DXY, which is pretty much gone down since March. And before this, I asked you about the reflation narrative. So do you have any thoughts on, say, for example, a specific currencies that usually reflect growth? So, for example, the Australian dollar usually tends to go up during good times, tends to come down during bad. So do you think those sort of currencies are as a whole overextended in this market?
Well, the Australian dollar is largely a proxy for commodity prices, right? So
that's true. Yeah.
If I'm fading the inflationary narrative, then by definition, I have a less than fully favorable view of the Australian dollar. I would suggest that Australia has some of the same dynamics that Japan has under conditions, very foreseeable conditions in which the US has to withdraw to a certain extent because of pressure in the Pacific theater.
And the euro? I said, and the euro, or do you have any thoughts on the euro?
I mean,
because
again,
that's sort of like the one that's sort of
now we're literally going around the world. You're asking,
yeah.
But no, I think Europe is tricky, right? Because Europe simultaneously has the opportunity to become a much harder currency. It has the challenge associated with a non-unified group of municipals, right? France, Germany, et cetera, can't print their own currency. but also don't necessarily have to agree to a fiscal framework, as we've seen with the violations of the Maastricht Treaty, right? That make it difficult for the ECB, right? They have not. Europe has not yet resolved its civil war,
Right.
And nobody is in charge. There is no federal institution that really makes policy for Europe yet. Whether they reach that point peacefully or whether it requires a more violent contest, or whether they ultimately fall because they are incapable of unifying without a significant external threat. And in many situations, I would argue Europe tends to be its own worst enemy, right? They're so excited by the schadenfreude of watching the US struggle that they're not paying attention to the fact that, they are a peninsula on Eurasia and are completely unsustainable as an entity without support from across the pond.
Right.
So, if you're Putin and you're trying to break apart Europe and you're trying to strengthen your hand in Europe, what's the single most powerful thing you can do? Get the UK to leave Europe. I mean, what an extraordinary coup.
Exactly. And I've got two more questions for you. So, if you were a regulator today, how would you move us back to normal levels of rates? Or do you think it's impossible right now without something falling apart, or something, for example, the over leverage of the system being a problem, for example? And, if so, how would you readdress that?
Well, so I actually think this is one of the interesting things that's going on is I don't really disagree with a lot of what we are trying to do, right? What we're trying to do is get the economy to run hot enough that it facilitates the raising of interest rates in the future. I think the challenge is that raising interest rates causes its own interesting features, right? The single biggest one being the loss of collateral. So when I raise interest rates, I lower bond prices. That in turn reduces the collateral that is available for borrowing. And in a heavily indebted society, that much more so than the cost of servicing the interest rate differential between 0 and 25 basis points or 25 and 50 basis points, right? That's the much bigger issue that you face. I don't think the solution can be found by tweaking the dials a little bit. I think the solution can actually be found by deciding that you're going to begin rewarding behavior in society that is designed to make society more robust and designed to make society less sensitive to the financialization dynamics. We fundamentally, from a regulatory framework, are captured by the idea of avoiding systemic risk, avoiding the crash that results in everybody stopping their spending, right? So the objective function becomes protecting wealth. Well, if you focus on protecting wealth versus protecting incomes, right? And to the extent that you're trying to protect incomes, you're trying to protect those incomes through the corporate sector, making sure people have jobs rather than the opportunities to create jobs or create their own businesses. If that's your objective function, then you're going to lead to more and more of the American public being forced into corporate jobs, right? That creates the dynamics of serfdom and servitude that we all object to and feel that insecurity, which leads to the fraying of society. And so to a certain extent, if we're going to change that pattern, we have to decide that we want something other than the corporate sector to provide that social safety net. That's what FDR did in the 1930s by introducing dynamics like Social Security and dramatically expanding the public sector, creating the competition for jobs that then led the private sector to have to compete by saying, hey, we're going to offer pensions, right? We're going to raise wages. We're going to improve working conditions. We're going to move the jobs closer to where you want to live, out of the cities and into the suburbs, right? That was a function of the corporate sector competing for labor resources. And we have to create something like that again if we want to see that type of improvement.
Right, got it. And to wrap up the podcast, I wanted to ask you, after your dog stopped barking, you briefly touched up on the issue of the China Taiwan conflict, and you said that one of the implications could be that Japan starts, importing more than it exports. Historically, it's been a country that's exported more than it imports. So are there any other implications of that conflict? And if so, what are those implications? And are there any risks that you see that could affect financial markets from the China versus Taiwan conflict?
Well, broadly speaking, I would suggest that type of fracture, right, where you're talking about the U.S. separating from China, and it's debatable how effectively we can do this, right? If the U.S. is incapable of separating itself from China, then it becomes more difficult to see the path forward. But in general, where these types of developments have occurred, you have seen a tremendous amount of resistance against the loss of those assets. But when you do lose those assets, as we saw in the late 1920s, early 1930s, where really the key catalyst was German default, the real catalyst was recognition that the new economic policies of the Soviet Union, et cetera, were beginning to fray. Effectively, those created conditions under which people were forced to reevaluate the corporate sector and the prospects of growth, right? And revealed the fragile underpinnings of the household sector, which had become very over-levered. One of the charts I was going through this with my son the other day, my oldest son, who's a college sophomore. We were looking at the adoption curve for television, right? And the S-curve adoption dynamics for television are fascinating because it was introduced in 1927, and this is obviously a very powerful medium that existed from the period of 1927 all the way through the period of today, to be entirely honest, although it's used more as a screen today than anything else. But there was almost no penetration of the television from 1927 until 1947, right? Why did that occur? Was it because the technology was not appropriate, because the technology was not fully developed? What's your hypothesis?
Would it be sort of that people had more important things to buy during the Depression and during the war years as opposed to buying televisions?
Right. So television was an extraordinary luxury good.
Right.
It was expensive when it was introduced. It was a product that needed to be financed. Mm-hmm. Right. So financing was broadly not available. And then you introduced the period of the 1940s in which all the productive capabilities of the U.S. were reallocated away from
World War II,
household consumption goods towards the war effort. Right. And so basically over that entire time period, this incredible invention looks like nothing else. And people present it and look at this S-curve without putting in place that recognition. Right. So when I think about what happens when you see that sort of break, or if an event like that occurs, I begin to say, well, what are some innovations that otherwise should be very straightforward that you would expect to move forward in a very powerful fashion that may not? And again, this brings me back to something like Bitcoin, where in just a really simple frame, it is dominated from its security apparatus, the mining apparatus, by Russia, Iran, and China, with those not necessarily being in order, China obviously being the largest player. If we're going to break with China, there's no way we're going to have our accounting system done out of China.
Right.
So again, to me, those just feel like pretty straightforward facts. And I would highlight that, there are no good answers to that, right? The security of the Bitcoin system is not designed to offset a nation state, a state actor attacking it.
Right. Got it. Thank you so much for being on the podcast, Michael. It was awesome having you.
I enjoyed it. Thank you very much.